Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today is our favorite day, the Primary Vision Frac Spread Count. So we're going to cover that, what are some of the intricacies that are happening right now, and then we're going to go through some updates on what does mobility activity look like, and then why does the physical market look the way it does versus the paper market, and what can we expect to happen over the near term. So before we get into that, please like, share, subscribe. Your support's always appreciated. So just to jump right in, the frac spread count is down 14. So we went from 175 to 161. Now, this isn't because people are going home or they're not trying to capture pricing. It's all to do about weather. I mean, if for anybody who is in Fort Worth, I think they're expecting now 5 inches of snow. If anyone who's down south, essentially anywhere from the North Dakota all the way down to Texas, are experiencing some insane cold weather, which is causing freeze-offs, delays. Right now, I know that there's commentary out there that pipes are being shut down. Because now the one thing that's important to understand is natural gas has water in it. So when you start to freeze at those levels, you have to actually turn off on what's called freeze-offs, where you shut everything down to protect the equipment in general. And that's what we're seeing. We're seeing trucks that are stuck because they can't get out because of either the cold, the weather, both. So this is creating issues right now, which clearly it's all transitory, as weather always is in energy, but it's just something to consider when we're looking at what is this going to be going forward. We expect to pretty much have a quick snapback within the next week or two, depending on how long some of these weather impacts will last. But again, this is weather related, not some big issue in terms of activity, because we still expect to see this general increase to about 185 by the end of February, and then a much bigger push towards over 200 as we're starting to see activity come back and really trying to build up, not just, building up from what we've seen over the previous few, let's say 6 to 12 months of, decline curves, and starting to arrest that decline curve and then starting to build in some growth. Not that we're going back to 12 million a day or 13 million a day, but something closer to maintaining as we cross over that 200 threshold and closer to maybe 230, getting to about 11.2, 11.3 million barrels a day. Now, one quick update when we start talking about Biden and what's happened with the moratorium on drilling permits. So here was a quote that came from New Mexico. So New Mexico's top oil regulator warned the Biden administration earlier this week that the order has caused confusion over approvals and stymied action on federal lands in the state. The Secretary of New Mexico Energy, Sarah Propst, Minerals and Natural Resources Department asked Interior officials for additional written guidance to BLM offices to speed approval of right-of-ways and other authorizations needed for existing oil and gas operations. So again, this is also the right-of-ways that are very important when we're thinking about connections, as we keep talking about the connectors being the biggest issue. The new data suggests that these delays in permit approvals related to backlogs in the normal bureau review rather than a holdup in the top ranks of the Interior Department. Roughly 5,500 applications for permits to drill onshore are now pending. Almost all of them, some 99.5%, are currently under review in the offices. The remainder are awaiting review from top career officials at the Bureau. Again, these are things that to consider when we're looking at some activity and what is this going to mean with approvals in general. So there is a backlog. So far the right-of-ways are being approved on Indian tribal land. So the question is going to be, how much does that continue? What do we see the snapback? So this is going to be something to watch, specifically in New Mexico and the Delaware Basin. Now, just looking at 2020 versus 2021, as we're looking at the activity in general. So typically February, we do see sometimes these weather events, so that it's not crazy to see something happen, especially with the polar vortex that has continuously pushed further and further south, causing freeze-offs in general. So this is something that we've seen before. The last time that we had it, it only impacted numbers for a week. This one, depending on how long it can go into next week, could be a bit more of an extension. But again, these are things that we're going to watch and provide updates on in general. Even with the reduced in activity, we're not back to even where we were in December 11th. So again, you can see that there was an impact, but we're still having that steady grind higher. Nothing ever goes in a straight line, especially when we're talking about crude in general. But you might say, what are we thinking when we're looking at why are they going to come right back to the activity? And it's a very simple answer. Look at front month pricing. So, we still have the level, or we're above 50 through about July of 2023. Now, it's important to understand that even though we've had this huge, right now we're at about 59.50 for WTI Cushing. So even though we've had this big move up of about $1.30, it's really pulled the front month up way more than the further down that curve, where we're still seeing some of that overhang. And that could be very much because this is just kind of a shot in the arm because of some of the issues that we're seeing with movements of crude on the ground, or it could be just more and more E&Ps looking to put pressure and hedging, which is putting that cap a little bit further down that curve. So again, these are things to look at or consider when we're talking about the paper markets. Now, the problem remains the physical market. So Angola has yet to sell 10 to 11 cargoes that it's planned to export in March, which is down from 14 to 15. But again, this is much slower than what it should be, especially given that next week they're going to come out with their new loading schedule, which we'll talk about when we provide an OPEC update. And then on the other side, Unipec and Total, they bought Urals in Northwest Europe at the lowest prices in 10 months on the Platts window, where CPC blend loadings for March are rising to a one-year high. So, what does that mean in general? And let's break that down a bit more. So Unipec bought for a discount for February 22nd, 26th delivery at a discount or less dated Brent of $1.75. Total bought something similar for a same period for less dated Brent, $1.85. Now that compares to, traded prices were the lowest since mid-April compared with prices for previous deals, which were less $1.10, $1.45. So we're seeing almost a 40-cent discount or 60-cent, 70-cent discount, depending on what we're using. That is really kind of putting that pressure to the downside when we're looking at Northwest Europe in general, and we're starting to see some pressure, and we'll talk about it next week. But Singapore cracks have turned lower. Well, now we're also starting to see Shandong refiners are reassessing throughput just based on what we're seeing on their margin, they've gone from about a $3.75 in December to a negative 75 cents in Feb. So again, that we're starting to see this pressure that's being pushed down onto the refiner, and that's causing some of these physical discounts. Now, it's important to also appreciate that the last time there was this disconnect between the Urals and physical pricing in the Urals in Europe and the paper market, when we had this wide disconnect, was early last year, right before we saw a little bit of a battle, if you will, in OPEC, and then we had that huge move down in pricing, which obviously came not just from what OPEC had done, but also from COVID spreading out. So again, these are things to watch when we look at the disconnect between the paper market and the physical market. Shell took advantage of it. They closed that gap quickly, locking in some profits. But when we look at the physical market, we also have to consider what is the activity looking like. And here you can see that just based on Europe, we've had some normalcy coming back in, and we've pretty much flatlined as we came from the end of January into February. We had that nice bounce off the bottom, as we came into Feb, but we're still not back to where we were at the beginning of January or even where we were before the holidays. So again, there's still some work to get back, but the U.S. remains fairly stuck at this, let's call it 65 level, which we keep talking about, where there's these pivots back and forth, and that's going to be to see how quickly we can kind of get some of that normalcy. But everything else is pretty much flatlined as we've come into Feb and averaging, if we take all of those together, at about 70%. So when we look at, what is really driving that, you can see North America is starting to get back up to where we were before Christmas, which is a positive in general when we're looking at North America. The PAD 5 in California is going to be a bigger part of that. But you can see that the rest of Asia is starting to recover back to some of that normalcy as we get some adjustments. South Korea still remains a bit slow, but India is coming, has been back. We have Malaysia starting to normalize a bit. But the problem is really China at this point, because China has seen a big drop off, and we didn't see that normal, spike that we see in before Lunar New Year, which just means that there's been a much bigger slowdown in terms of, I think, what was expected, where there was we was hoped that it was going to be a little bit better than last year. We're starting from a higher base, so it will be, but again, there's still going to be some concern, which we're seeing reflect in Angolan cargo sales, as well as some of those crack spreads. Europe is stabilized, as well as was shown in the earlier charts. And the question is going to be, okay, well, what is happening here? And when we look at all advanced economies, again, looking at some of those averages that we're trying to figure out where things are fairly flat on the advanced economy side. Emerging markets continue to grind higher, even despite China, when we're looking at what is happening on the Chinese market. And a lot of that recovery in the emerging market side is really being driven by some of these Southeast Asian countries coming out of some of their recent lockdowns, and India starting to see a bit more mobility. As you can see here, with India being that key red line, we're getting back to and taking out those the highs right before the outbreak that happened, closer, when people got a little concerned about after the holiday season, and which ended with Diwali, and we had some lockdowns, or at least some stringency remaining. That is now passed, and you can see some pretty steady growth, which has been a positive and helping move that general activity up. But with that, what are we seeing in the U.S. right now? And it's important to think about, okay, well, what is crude? What are commodities in general? And when you think about movements and preparing for inflation, this is one where we're going to look at the 30-year chart, which had a weaker auction yesterday, which it's important to understand, well, what is a weak auction? Well, it came out, and the auction tailed by about a basis point, and it stopped at about 1.933%. The bigger issue is the bid to cover, which is a good way to gauge what is the activity, what is the demand, which came in about 2.18, which is much lower versus about the 2.4 that we saw previously. 2.3 is kind of that average that we've seen over some of the others. Some of the other auctions, it had gotten as low as about 1.97, which was a bigger problem, but we saw some of that recovery. But as the 30-year has bumped up, so has the 10-year. The 10-year reached crossed the high that we haven't seen in over a year. So these are going to be things to watch as the investors start to price in a bit more inflation. We're starting to see some of these runs in commodity prices. But even as we're seeing that, as we talked about with refiners still remain fairly stable, with remaining pretty elevated averages versus the seasonal norm. We're going to see a little bit more pressure again, as we talked about, with some of those crack spreads coming down, which is going to keep this fairly elevated through the remainder of February. And then when we look at stockpile adjustments, again, these are things that we're going to talk about in a bit more detail when we talk about OPEC, the OPEC show. The IEA adjusted some of their assumptions, and right now they sees a bigger end 2021 oil stockpile surplus than it did a month ago. OPEC sees the opposite. Again, we're starting to see some of this bifurcation of what are the demand estimates, and demand is kind of the unknown at this point, as people try to get a pulse of what should we expect as lockdowns remain fairly sticky in Europe. Jet fuel remains, jet activity and airline activity remains fairly muted. Diesel, the bright spot, depending on where we're talking about, and then gasoline seeing a little bit of some support. So again, these are the pushbacks that we're continuing, as refiners, the biggest buyers of crude, still remain well below seasonal norms, and the current crack spreads aren't really going to help that anytime soon. And this gives you an indication in terms of some of that divergence, looking at the historical stock builds, so change in cumulative stock builds between January and February by the IEA versus OPEC. You can see just where some of these adjustments are. So what does that mean on a cumulative basis? Well, the IEA now sees global oil stockpiles at the end of the second quarter of 2020, the point at which it sees the balance of shifting from stock builds to draw of 173 million barrels higher than it did a month ago. In stark contrast, OPEC sees them at being 121 million barrels lower than it did in January. So we're just trying to look at what was the divergence in terms of historical levels, because when you look at the historical side, that gives you an idea of where are we actually currently sitting right now. So let's, again, a month ago, the IEA saw excessive global stockpiles at the end of the second quarter of 2020, compared with the end of 2018 levels of 1.57 billion, while OPEC assessed them at 1.49 billion, a difference of 84 million barrels. Over the past month, that gap has widened to 378 million barrels as a result of the changes to historical demand estimates. The IEA now sees global oil stockpiles almost 820 million barrels above end 2018 levels by the close of this year, up from 421 million barrel surplus seen a month ago, while OPEC sees the surplus at 380 million barrels, down from 690 million in January, assuming in both cases that the producer groups stick to its current output targets with no further increase beyond ending Saudi Arabia's voluntary cut in April. Now, these are things that are coming from Bloomberg, some quotes from them in general in terms of some of the movements. But again, you can see how the adjustments in demand, supply, which is why we try to look in the EIA show or OPEC show, looking at the full suite of products, starting from the oil side, what is being produced, what is being stored onshore, offshore, and then floating storage is obviously the big component of that. And then what do those demand metrics look like? Because right now we've had new tank farms come online in China. We see their refinery runs increasing, which as they increase their refinery runs, then as they start to ramp up, there's going to be more exports of refined product, which is going to put pressure on other areas that are going to force to either have economic run cuts or maybe even completely shut down, as we've seen in Europe, Australia, and parts of the U.S. These are things that we're going to look at to see how is demand adjusting, and then when we look at refiners, what are those crack spreads doing? Because right now the feedstock prices continue to go up. Corn prices remain elevated, which is going to push ethanol prices higher, which is going to increase the cost of gasoline, which, again, the refiners try to push through. So what are they able to sell the end market with? What is the feedstock cost, and what can they make in between? And those pressures still remain, which is going to be that net overhang for that normalization of demand, as we keep talking about wage pressure rolling through, unemployment remaining elevated. These are kind of those economic headwinds that we talk about, and if we look at grains, commodities in general, inflation keeps pushing prices higher, as well as shortages in the market, supply chain problems. So again, lots of things to look at when we're talking about how do these commodity prices shake out as the paper market and the physical market still have some of that disconnect, which should be closed at a certain point in time, which, as to when remains to be seen. So we hope you have a great weekend and a great President's Day weekend. I know some are traveling, so hopefully, safe travels. Enjoy the slopes for those that will end up at the on the mountain. I know some have spring break, so hopefully you have something planned that's safe but warm, because we have a lot of cold spreading through. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.